All right, let's talk about a sector you might have written off completely: small cap energy stocks. You know the ones I'm talking about, the smaller players in the energy world that have always had this reputation for being, well, a total roller coaster. All boom and bust. But here's the thing: something big, something fundamental has shifted. The game has totally changed. What used to be a high-risk gamble is starting to look a lot like a classic underdog comeback story. So let's dive in and see what's really going on.
Okay, so let's just get right to it, right? The big question on everyone's mind. When I say small cap energy, what's the first thing that pops into your head? For most people, it's probably crazy volatility, wild speculation, and companies just drowning in debt, right? But is that really the whole story anymore? Well, that entire picture is being flipped completely upside down, and we're going to get into exactly why.
So to really get why today is so different, we got to take a quick look back in the time machine. We need to see the old playbook, because for decades, these smaller energy companies were playing a totally different game, and frankly, it was a much riskier one.
Back then, the playbook was super simple and honestly pretty reckless. It was all about growth at all costs. I mean, these companies would just pile on mountains of debt to drill. The only thing that mattered was cranking up production volume. But what did that create? It created these super fragile businesses that were completely slaves to the whims of oil and gas prices. One price swing and boom. It led to those brutal boom and bust cycles we all remember.
But here's the good news. That is the old story. Today, we're seeing a whole new breed of small-cap energy companies, and they are tearing up that old playbook. Instead, they're focused on two things that used to be almost unheard of in this space: financial discipline and creating real, sustainable value.
And when I say they're rewriting it, I mean it's a night and day difference. It's a total pivot. So instead of just chasing production volume, now it's all about profitability. It's about generating actual free cash flow. Instead of sky-high debt, we're seeing much more conservative, healthy balance sheets. And that whole frantic, speculative growth thing, it's being replaced with a focus on creating lasting value for the people who own the stock. This is huge. It's not just a little change in strategy, it's a complete shift in the entire philosophy of the sector.
So, they've got their own house in order with this new financial discipline, but that's not all. They've also got a secret weapon, an external strategy to shield them from all that market chaos. You can think of it like their financial safety net.
And what is this safety net? It's something called strategic hedging. Now that might sound complicated, but it's actually pretty simple. It's basically like buying insurance on your future prices. What companies do is they lock in a set price for the oil and gas they know they're going to produce down the road. Why is this a game changer? Because it just demolishes uncertainty. It gives them a stable, predictable river of cash flow, and it doesn't matter if the market is going haywire on any given day.
And listen, this isn't just some theory they teach in business school. This is happening right now. Let me give you a perfect example: a company called Crescent Energy. Get this, they've already hedged around 60% of their entire production for 2025. Just think about that. A huge chunk of their revenue for next year is already guaranteed. It's locked in. Done deal.
Okay, so what does that actually mean for you, the investor? Well, when a company has that kind of stable cash flow, they can do a lot of great things. They can keep their operations running smoothly, they can make smart investments for the future, and here's the big one: they can pay out consistent dividends. It completely transforms these stocks from a wild, volatile gamble into a much more predictable, much more resilient investment.
All right, so let's put this new model through a stress test, shall we? Imagine oil prices just tank. Let's say they drop by 15%. Now, in the old days, a hit like that, oh man, it would have been an absolute catastrophe. It would have wiped out tons of these smaller companies. But today, it's a different story. Because of that new playbook we've been talking about, the stronger finances and that clever hedging, a lot of these small caps just sailed right through that storm. They proved they could handle it. They protected their capital. They kept the lights on, even when the market was ugly. And that resilience, right there, that's the ultimate proof in the pudding. It shows this new way of doing things actually works.
Okay, so we've talked about the what and the how, the new strategy, the financial tools. But now let's talk about the who. Which companies are actually out there on the front lines making this happen? Let's throw a spotlight on a few that are really leading the charge. So here are three really interesting examples, and what's cool is they all do something a little different. You've got these things called royalty trusts like Sabine and Permian Basin. They basically just own the land rights and collect checks. Then you've got a service company like Ranger, which is in the trenches supporting the actual drilling. This just goes to show you there's a lot of diversity here. It means you as an investor can pick the kind of exposure that you're most interested in. Let's start with Sabine Royalty Trust, ticker SBR. Now, their business model is honestly fascinating.
They don't drill a single well, they don't operate any rigs, nope, they just own the rights to the land and sit back and collect royalty checks from the companies that are doing the drilling. The whole thing is just a machine designed to pump out consistent income to its shareholders.
So has it been working out for them? Oh yeah, you could say that. Check out this number. Sabine has delivered an incredible 32.1% compound annual growth rate in its earnings per share over the past 3 years. I mean, wow. A number like that tells you pretty much everything you need to know about how powerful this model is. All right, next up we have the Permian Basin Royalty Trust, or PBT. Now, it's similar to Sabine, it's another royalty trust, but its superpower is location, location, location. This gives you a direct investment in the Permian Basin, which is, without a doubt, one of the richest, most productive oil patches on the entire planet. And you get all that upside without any of the headaches or risks of actually running the drilling operations. It's pretty sweet.
And last but not least, let's look at Ranger Energy Services, RNGR. This one's different. They're a wells services company. Think of them as the picks and shovels of the oil boom. As long as companies are drilling and producing, they're going to need Ranger services. So Ranger is perfectly positioned to profit from the overall health and buzz of the entire upstream energy industry.
Okay, we've gone through the old way, the new way, and seen some real-world examples. So let's boil it all down. What are the big takeaways here? Why should this totally transformed sector even be on your radar?
Well, when you really look at it, it comes down to 4 massive advantages for you. First, you've got real potential for sustainable growth, not just some wild bet. Second, you can get actual income. We're talking attractive dividends that are backed by that super stable hedge cash flow. Third, you've got resilience. We saw how they can weather the storms, which means less risk for you. And finally, it's an amazing way to diversify your portfolio, giving you a piece of these really specific, specialized corners of the energy world.
And that really brings us to the final big picture question. For decades, everybody knew the risk in small cap energy. It was one word: volatility. But now that the whole sector is changing its stripes, you have to ask yourself a new question. Maybe the biggest risk today isn't the volatility that these companies have learned to manage. Maybe, just maybe, the real risk is ignoring this massive evolution that's happening right in front of us.